All right, you guys, this is being recorded. Something I mentioned at the beginning of all these webinars is watch this again, especially if you're new to options trading or the way that I teach, because some of the nuances or these rules that I have before being able to implement these strategies could go by you, or maybe you're thinking of a question or something like that and you'll miss something. So watch it again relatively soon. One of the things I always say is I started out with a psychology degree, and I know that if you review the material relatively shortly afterwards, you're going to actually understand it and remember it longer. If you wait a month down the road, it is going to be like learning it over again. So try and watch it relatively soon afterwards. You don't actually have to watch necessarily this long put diagonal, but maybe one of the other ones where I might cover some other material as well. You'll be getting it just as well. So this is going to be on the long put diagonal. Might be a good time to implement this with the entering into a bear market scenario here with everything that's been going on. But let me get a couple things out of the way real quick. My name is Eric Wilkinson. For some of you newer people that may not recognize me, I did things on CNBC or other mainstream media where I talked about geopolitical, economic, and market analysis. I've been trading my own money for about 28 years now. I started out in college with that psychology degree that I was talking about, switched it over to finance, and after graduating, a buddy of mine said, you know what, you would be perfect on the floor of the Board of Trade. So I packed up my bags and literally moved to Chicago, walked around on the floor, got a job as a runner, one of those guys that run around on the floor passing out paper. Moved up to the pits shortly after. Those are some of the runners, the desk guys there, and started trading in the pits. I've been trading my own money ever since. So actually ever since college, I've never traded anybody else's money. So I've traded in most markets throughout my career, everything from stocks, financial futures, currencies, options, and all kinds of products out there. In just about all market conditions. And I can say that these are new times for me as well. As even if you're a new trader, I doubt you will see something like this for a very long time. So this is unprecedented at this point in time. Can you touch upon this long put calendar is a good strategy for this bear market? This bear market where we are having massive moves, it absolutely could very well be. It's all going to be dependent on volatility and how that works out. If the market goes down and touches on that short put, keep in mind, yes, it is a short put. Somebody could put the stock to you, but we're going to be long another put as well. And when we're talking about option strategies, if you are buying a put, you have the right, but not the obligation to assign that stock or take that stock, okay? In this case, we're going to be able to take stock away from somebody, and that will be able to short us. The put stock to us, that's the short one. If somebody put that stock to us, we would be getting long there. So in a sense, we are going to be getting short at a higher level than where we are being able to buy, even if it's below there. And I'll explain all of that. One of the things that we don't want to have happen is having the volatility really spike in that back month. But, you know, right now with the volatility concentrated in these front months, it's actually, we're getting paid for that risk taking of shorting those puts in those front months. And there's so much skew to this downside. It very well could be. You could be in and out of this trade rather quickly. All right, we got to go over this disclaimer. Keep in mind that everything, we are an educational company in here. I may be talking about stocks that I own in my portfolio. I am never trying to get you guys to lemming off the cliff with me. I hate that herd mentality or go out there and tell you guys, you know, this is a stock that you guys should be, you know, investing in or shorting or any of that stuff, because I don't know your risk parameters. You very well may have a different outlook on what's going on right now. And that might be a better idea or a better, I'm trying to think of the better word for that. But, you know, you guys might be right. I'm wrong. You know, I'm kind of thinking this virus thing is a little bit overdone, and I might very well be wrong. So, you know, it's up to you to come up with your own, use your assumptions to implement the right strategy. I'm just talking about in these, what the right environment is, what the right strike location is. And I have reasons for that. Over my 28 years, I've come up with different scenarios. I've forgotten a lot about options, probably more than most people know. So, when I'm talking about building these strategies out, I'm not trying to get you guys to implement that strategy tomorrow. Okay. So keep that in mind. It's all for educational purposes. We're trying to teach you guys how to swim. I'm not trying to sit here and swim for you. All right. You guys can follow us on Twitter at Wolfman's blog is me personally. Again, no solicitations. Everything is chatter there. And Pro Trader Strategies, they put out a lot of good market stuff and deals out there. You can follow us on Facebook, where we're pushing out a lot of content that we're doing. It's not everything, but we do every once in a while throw some content out there. Some of the videos and webinars and stuff like that you'll be able to get access to. One of the things is it's not always in order, and it's sometimes a little bit more delayed than what our other services are going to be able to get you. All right, so again, this is on the long put diagonal. One thing is, I will never teach the short put diagonal. The reason why is because that short put is so far out that I don't want to be short in a long duration. I don't want to be short options of any kind in long duration. So I only teach the long put diagonal. If I were going to teach the short put diagonal, it would only be a pretty boring video, because I'd only be talking about why you should never implement that strategy. It's just too much risk in my eyes for anybody, even a person that has high risk. It doesn't fit with the philosophy of what I've come up with for rules in and around implementing a strategy. So therefore, I'm not going to do that. All right. So long put diagonal. We are going to be, the reason why it's a diagonal is because we're going to be using different strikes and different expiration months. If it were a calendar, we would be looking at the exact same strike location, which is probably why the long put diagonal would be, to answer John's question, a better option strategy than the calendar, because the calendar, you want definitely to move a little bit more sideways for a longer period of time, or have some kind of bullish move in the very near term to be able to get out of that put, that short put that expires earlier than your longer put. So with this one, we're going to be buying an in the money put. That one's in the further expiration. So you're going to be able to hold on to that longer put. So if we're talking about this, let's just say if XYZ is trading, my pin's not going to, let me pull up my pen rather than the arrow. So let's just say, for instance, XYZ is trading around 100, all right? So we've got XYZ here. It's trading around 100. And for instance, we're going to be looking at the 95 puts. That's going to be the ones that are in the money, right? These are the in the money puts that we would be buying. We'd be buying those 95 puts and then maybe selling the 105 puts, all right? And we'd probably do this for, this isn't going to be a very good example of it, but so these are the out of the money puts. And these are, say, about 35 days to expiration, let's just say, and these are going to be about the, 75 days to expiration. So something like that. So keep in mind, we're short the, actually, I did that backwards. Sorry. Hold on a second. Let me get my eraser up here so I don't confuse anybody. Erase. Why aren't you going to erase for me? Eraser. Doesn't want to erase. All right. Buying these and we're selling. Oh, now it works. Buying those and we're going to be selling those. All right. So, and these are going to be the 35 days to expiration. And these are the 75 days to expiration. Sorry about that. Anyway, so these are the in the monies then. In the monies, and these are the out of the monies. Sorry, change all that around. So we're buying the in the money puts, and we're selling these nearer duration out of the money puts. So if the market goes down to 95, then basically you're getting that width of the spread. So if somebody made you short at 95, well, or long at 95, if you got long at 95, and even if it's trading 90 now XYZ is at 90, and somebody said, all right, well, now you're long at 95. Well, then you just basically get the stock from somebody else at 105. So you're going to be able to make up that difference minus the spread. Sorry, yes, John was all over me. I should have read yours. You were probably on top of it before me. So these are the in the monies, the out of the monies, and we're going to be shorting the out of the monies. So somebody, when you're shorting it, you have the obligation to fulfill that contract. So somebody could put the stock to me at 95 when it's trading 90. But because I bought these at 105, then I can get short up there at 105. Get short at 105, long at 95, and I make the width of the spread minus the debit paid. And I'll go into all that here a little bit more, so hopefully I can tap off some of that confusion here. The assumption is going to be the market direction is bearish for the most part. But the reason why I throw in that market neutral, which is probably why John is asking, is this a good environment for this? Well, the market neutral is because we want that short, like in that other example, those short 95 puts to expire worthless. All right. So that helps us out in this strategy. So if those expire worthless and, they go out, then basically we have those 105 puts that were long, right? We got the 105 puts were long, and the market can continue then down. All right. But keep in mind, if it goes down there and hits my 95 puts, I'm likely just going to cover this whole trade because then I'm going to have very close to my max profit. If it happens in the next couple of days, it's not going to be absolutely your max profit potential that I'll show you at the end of this, towards the end of this webinar when we're doing the max profit, max loss, and all of that stuff. But you're going to be able to see a pretty good gauge because when we're doing max profit and all of that stuff, you have to remember that is on expiration day. And one of the things I say is I don't hold anything out to expiration usually. So a lot of things can change in and around that, like the volatility and all of that stuff can, spike or come out, and that can really affect the profit and loss on that. And I'll talk about that too. All right, so the essentials to success. We want tight bid ask, and usually, you guys, I know there's a lot of names out there that I've seen for a long time. I usually say, if XYZ is a stock that is less than $100, right? Oops, $100. If XYZ is less than $100, I say from the bid to the offer that we need it to be less than 10 cents wide, right? Now that is in normal market conditions. We are not in normal market conditions right now, so it's not going to probably fit that rule. We're going to talk about different ways to look at it and find that right strike location. So right now, what we're going to have to look for is volume. All right, we need volume and open interest. All right. So look for volume and open interest because that tells us there's a lot of eyeballs on the market. All right. So we've got eyeballs looking there, and he is, checking it out. There's people watching that market. If there's a lot of volume and open interest in there, that means there are a lot of participation. There's people in there. These markets are really wide right now. And the reason why they're wide is because there's volatility, right? We're seeing these massive swings with the Dow Jones and the E-mini S&Ps. So the reason why they get wider, despite the fact that there's a lot of people watching it, is because they have a hedge, right? If they're selling a call, they are likely going out there and buying the underlying, okay? So what they're taking into account is that risk, that lag time can be the difference between them making money or not making money. So what they're going to do is make those markets a little bit wider. If you come inside of that, they're going to lean on you. So they're going to say, all right, well, he's got his call strike there. If I can go out and, if he's offering the calls, I can go out there and try and sell the underlying and buy the calls and stuff like that and try and create a spread. Or if you're going out there and you're buying the calls, then he's like, if I sell the calls, I need to buy the underlying, and I need to have that wiggle room in order to make up for the markets just moving back and forth a lot. And then normally, under normal circumstances, if XYZ is a stock that's greater than $100, then I talk about, you can easily just move the decimal place 3 ticks to the left. And, so if XYZ is equal to, say, $200, then I would move that decimal place 3 ticks to the left, and I would say 20 cents, okay? Right now, XYZ at $200 is probably going to be $1 wide, you guys. But again, go back, check out volume and open interest. If there's no volume going on, just 1 or 2 lots trading, at every other or every 5 strikes, and there's only, 100 open interest, then I would stay away from that underlying. If there's thousands of open interest and 100 contracts or more trading on any given day, then that's probably a pretty good market to start at. With this strategy, though, the beauty in it is we don't have to do a whole lot of price discovery in order to find out if we are pricing our options correctly, because a product of this strategy is that we can figure out with the debit we're paying on this on this strategy and correlate that to where the underlying is trading. And if we can match that up pretty good, we know we are doing this strategy at value. So stay away from still lack of volume and open interest, because it makes it harder to get in and out. But ultimately, I'm going to show you a different trick in order to figure out whether or not you're pricing this incorrectly or pricing this correctly, to make sure you I don't misspeak on that. All right, so the right environment. Now, right now, volume or volatility, this is all about volatility, all right, volatility. And normally what I talk about here is we need less than 2% between the month that we are shorting, which is that front month, and the back month. And usually, if you guys have watched this course from the beginning, we've talked about volatility. Volatility affects further duration options more than it does the nearer duration. Well, like I said, we are in unprecedented times. And right now, volatility in the front months is higher than the volatility in the back months. So that's okay, because remember, the volatility in these front months, the nearer duration, that volatility is higher. That means we're getting paid more for selling those options. We're buying volatility really cheap in that back month, all right? So that is good. The reason why we don't want to pay up for that volatility in those back months is because if volatility comes out, then it's going to hurt us. But we're compensated for that in these front months. These front months are blowing up with volatility. And so therefore, if we're selling those and that volatility starts coming out, it's going to help us out with the strategy much quicker. It's also going to help us get our short puts further away from where the underlying is trading. So that is a good thing as well. So we're going to be able to play that. So usually I say volatility less than 2% is a green light. So this is a green. I can't change my pen color on the thing on this one. And then if it's basically 2 to 4%, that's like a yellow light. But right now, if it's less than, so right now we're seeing volatility higher in that nearer duration, so we don't really have to worry about this so much, all right? But usually that is a pretty good rule. We're not going to even see this happen where we have to figure out that the back month is higher by what difference. Right now, the back months are much lower across the board. All right, the duration. The reason why we want to sell with this 35 days to expiration, as you can see here, these are days to expiration here. We want to sell our puts here and buy our puts out here, because if we're short, we want theta. This is a representation of theta coming out. So if theta is greater up here, then our short options, we'll be able to sell them high and buy them low, which is good. And if we can hold on to that theta, then that is good for our strikes, further out in time. What we're seeing right now is that the volatility is kind of pushing up on premiums. So when that volatility comes out towards the expiration, as it starts becoming less likely, we'll see those premiums really tank. Right now, they're holding on. It doesn't feel like there's much theta going on in the markets because volatility is so elevated. But when that volatility comes out, it's going to really help us in this strategy. All right. So picking the right strikes. Now, I talked about this when we're talking about that 105 strike there. That's going to be, we're going to buy puts in the further duration, in the money puts. We're going to be buying, these are the in the money puts. These are going to be about a 75 to about an 80 delta. All right. And then the ones that we're going to be selling, the puts that we're going to be selling, these are the out of the monies. And these are going to be about a 35 to probably 25 delta. Okay. So I'm leaning towards this 25 delta, to some of your guys is like worry about this market moving and stuff like that. 25 delta right now does have a chance of getting hit or kissed. Remember, one of the things I've mentioned in other webinars in this course is 2 times the delta is equal to the probability of us getting kissed. So there you go, smooch. That's a bad smooch, but anyway, 2 times the delta is the probability of getting kissed on the market, coming down and touching that strike location. It's only a 25% probability of being in the money, or if you use the 35 delta, it's a 35% probability of being in the money at expiration. But with this strategy, remember, we're going to be able to cover this as soon as we get kissed. So it's a pretty good probability that's going to happen, especially in these markets. It feels like anyway. Keep in mind, probability or the deltas get further away as volatility expands. Delta is also a product of volatility, and with volatility being as high as it is right now, we're able to get further away from where the underlying is. It's not like if volatility was super low, that same 25 or 35 delta would be much closer to where the underlying is trading. We're pretty far away in normal circumstances. All right. And with this, our debit, we want to have it be less than 75% the width. All right. So the debit needs to be 75% less than the width of the spread. Now, with the volatility being in the front month versus the back month, it's going to be a little bit easier than normal circumstances. Usually, if the volatility is way out there in the back month, then you have to play around with this, make sure you're on your toes, making sure that you're setting this up correctly. So bottom line with this one is we want to pay less than 75% the width of this spread. We want to make sure we cover our extrinsic value of those in the money puts, right? These in the money puts are going to have intrinsic and extrinsic value. Extrinsic value, you guys, is all of the stuff like volatility and theta that is pumped in there. The intrinsic, think about this, is intrinsic. It's what it is worth. Intrinsic is what it is worth. It's internal. Extrinsic is all the other noise that goes on around it. You can think of it that way. So when we're buying that in the money put, we want to make sure we're paying for just the intrinsic value. So now when I was mentioning earlier, when we're setting up this strategy, when we're paying off that extrinsic value with this put here, that put, we're going to be able to pay off the extrinsic value. We're buying this underlying for what it's worth. So we can figure out the in the money put minus the debit paid should be around where the underlying is currently trading. All right. So think about that. If we're buying an in the money put and we're only paying the intrinsic value, well, then when we add or subtract that debit from the strike price, then that's where the underlying should be. So when I was talking about this 105 put and the underlying is trading 100, then we would be assuming we're paying a debit of $5, right? Because then that's what the put is actually worth, right? We pay a debit of $5. We subtract that from there. It's 100. That means we're buying this strategy right there at where the underlying is currently trading. Are you saying that the 75, 80-ish delta of the long put drops as the price drops? No, I'm saying what I'm saying with the 85, if you're having an in the money put, as the price drops, those deltas are going to increase. All right. Those deltas are increase as the underlying drops. What I was saying is that, in low volatility, I think what I was saying and what you're referring to in low vol, a 35 delta or a 75 delta for that matter is going to be much closer to, XYZ's currently trading right in between there, right? So in this case, in high volatility, the 35 delta is here and the 75 delta is here and XYZ is trading, there. So they're further away. You're going to have, a 35 delta, 37 delta, 40 delta, stuff like that. Okay. This one's probably, in really low volatility, 35 delta, maybe a 45 delta, right? Those are going to be your strike locations for that underlying. Does that make more sense? There's just going to be more delta on the strikes in a sense. And I'll show you, we'll pull that up when I get this platform up here in a second. Where's my marker? Does that make sense? I thought you wanted higher volatility at the short strike put. You do want higher volatility with the short strike put. I'm just talking here, I'm talking about on any given expiration cycle. This is one expiration cycle. This would be one expiration cycle. Just call it, 50 days to expiration as an example. And this is the equivalent 50 days to expiration. And, XYZ, let's just say it's ABC over here. ABC is experiencing higher volatility, all right? And ABC is trading 100 and XYZ is trading 100. Delta is just telling us the probability of being in the money, and if volatility is high, which it is right now, volatility is a product of, the percent moves, in that underlying. So for instance, right now, when the VIX is, say, trading in the 40s, that's saying it's about a 4% move on a daily basis. We got that spike up into the 60s today, and that's basically saying it's 6% move. Okay, so when the VIX is trading at, let's say, 15 or 20, that's saying basically a 1% move on a daily basis, right? those deltas are going to be much tighter to where a 35 delta is going to be tighter than when it's trading at around a 60 VIX, right? Because there's a probability of a higher move. But those probabilities of a higher move are still the probabilities of being in the money. Does that make sense? I'm getting a little highbrow for some of you, I'm sure, but hopefully we'll be able to explain that away. Let me get one more thing. All right. Pay no more exit strategy. One of the things is, remember, we're not paying more than 75% the width of the strikes. When the positions meets at least 50% of max profit, that's where I'm going to cover it. All right. So our max profit will go over here in just a second. I usually say if the underlying, if the market trades down to my short put strike, that's where I exit. All right. So if we get that coming down and hits my short put, I'm going to cover that trade no matter what price I get for it. It's most likely going to be at least at 50%, 50% of max profit. All right. So our max profit on this is the width of the strikes minus the debit paid. So let's just look at it like this. The width of the strikes minus the debit paid. I told you we're not going to pay more than 75% the width of the strikes. So let's just look at it like this. We've got the, just go back to that one example. We got the 105 puts that we're long. We're long the 105 puts, and we're short the puts that are around 95. We've got a $10 wide spread, right? And we paid $7.50 because we're not doing more than 75% the width. That's our debit. So our max profit is equal to $2.50. So I said, we're going to take 50% of that to get out, right? So I'm getting out when I've got $1.25 into this trade, or my spread is worth $8.75, right? So I paid a debit of that. When this increases in value by $1.25, I'm out at $8.75. And that'll happen if the market comes down and touches my short strike, okay? If you let that short put expire, basically you have all the way to zero as a max profit, but we're going to get out relatively soon on this. Max loss is the debit paid. So it's a debit spread. So the max loss is whatever that debit is that we paid. We know we can't lose any more than that. All right. If the market rallies, that debit paid is what we're going to lose. And our break even, our break even is that strike price. Is going to be that long put strike price minus the debit paid. That's where I was talking about. We can figure out what the value is, because our break even should equal to where XYZ is trading. XYZ is trading. All right. It's going to be basically as close to that as we can. All right. And that's at expiration. Our break even, we want to set this strategy up so it's like equal to our break even. Now, obviously, if volatility starts expanding in that front month and goes down in the back month, that's going to hurt us a little bit. But all things being equal, at expiration, our break even is going to be that long strike price minus the debit paid originally. All right. So let's pull up, because I see there's some questions out there. Let's pull up the trading platform. I've got an example here. And hopefully, you know what, let me pull up this because I screenshotted. Yeah. Right now, like after the close, when I was talking about that, the markets and stuff like that, you can see here, ConocoPhillips, they are super wide. It's a $20 stock, right? And the bid offer is super wide here, not fitting that rule that I originally talked about. We could go over here and look at volume and open interest, and we can see that there is some pretty good volume on any given day. Not a whole lot in there really right now. People are staying away from the tight at the monies, but there's still some open interest and some volume in there. It's gotten pretty wide. You know, you could look at a Costco and see that there's some good volume and open interest in these markets. So most of the open interest on any given day is going to be higher than we are currently. But you can see even with a $200 stock, I would normally say 28 cents to bid ask, and we're not getting that. It's almost like 2 decimal places at this point in time. But there's still some good volume and open interest. How are we going to figure out if the right price is? Well, if I were to go and look at the bid ask, let me do that volume high, low, or whatever. That's a little bit confusing. I'll go to this. So when I was talking about the deltas on this, I'd have to widen it out. Let me go to something a little bit more closer to this. All right, so one of the things I usually do is I look at the ones that are closer in duration than these puts that are, you know, closer to the expiration, the one I need to sell, because that is all extrinsic value. Any option that is out of the money, puts or calls, is all extrinsic value. So if I'm looking at these 35 delta puts, then I know that this is all extrinsic value. So if I were to sell those, I know I have probably about $9, really, to be quite honest. $9. It'll adjust the mid-mark when I pull all this up. $9 that I can pay for on these in-the-money puts. So you can see that these 65 deltas are the ones that are a little bit better for that. So if I were to buy that, about $8 is extrinsic value. That's a little bit of floor trader hack. If you look at the if the in-the-money puts, you look at the corresponding calls, that's usually about what the extrinsic value of these puts are. Well, what we could do is take our calculator, been a brainwashed day, so I'm going to pull this up just to make sure that we got everything lined up. So the 75 puts, remember I said our break even is minus the debit paid. So if we take the 75 puts minus that $18.88, all right, sorry, I should have done that as 1. So 156. If I were able to get this, so I should do this way, the 175 handle minus, just so it's all hunky-dory. On the floor, we used to always just drop the 1. All right, so basically equals 156. You can see the underlying is trading at 145. My break even is above where the underlying is trading. So I've more than paid off my extrinsic value if I'm able to get this trade off at that level. So that's good. That means when I sold this put, it paid for all of the extrinsic value and a little bit more. You know, if this was, you know, 154.12, then that would be basically meaning that, you know, I am right there at value. So as long as when you do this, what your debit is minus the the strike that you're buying, as long as it wasn't below that, then you know you paid off all the extrinsic value. All right, it means you have all intrinsic value in here, and I paid off a little bit more. So that's the kind of scenario you want to set up for that. Now, the other thing is we'll have to see if this works. We have $30 wide here, so so the $30 minus the $18, or divided by the $18.88, we need to figure out whether or not, oops, I did that backwards. The $18.88 divided by that $30 wide, what's that difference? 62%, 63%. So that would fit the rule. It's less than 75% the width of the strikes, right? So that would be a good spread if I were able to get that off. My guess is I'm probably going to be paying closer to $21 on this. So if it was $30 wide, oops, I got to do that. $21 that I had to pay for it to $30, that's about 70%. So if I, you know, 21 minus 75 puts me right there at 54, right? So that's right where the underlying is trading. So if I could, if I wasn't able to get this for a debit of $18.88 because these markets are super wide, then I would be willing to go to $21. Puts me right there at the break even. I see a couple of questions. One thing to note, see, this is what I was talking about with the volatility. 67 volatility here, 61 here. So this volatility in the front month is higher than this month. So we don't have to worry about that rule of being less than 2% difference. This is higher. That usually the front month is volatility is lower, and that's where, so if this was like 68 or 71, if it was 71, it would not fit my rule because it increased too much. Generally speaking, volatility affects the further duration options more than the nearer duration. In this case, we don't have to worry about that. All right. If volatility is lower, we're selling this volatility, which is why I'm able to pay off all of that extrinsic value relatively easily. All right. Does that make sense? All right. I see a question. Today, the questions, why are we, okay, I attended paid class today where the question is, why are we paying $6.30 for a $4 wide? I don't think we are. Oh, you attended a paid class and they told you you're paying $6.30 for a $4 wide? You would never do that. You're locking in a loss. If you're paying more than the width of the strikes, which is one of the things that I always talk about, if you're paying more than the width of the strikes, you're locking in a loss. Yeah, if you're paying, that's something to keep in mind. You don't want to pay more than 75% the width of the strikes because you have to be able to have a product in there where you can make some money. If you're paying more, if you're paying $6.30 on a $4 wide strategy, you've locked in a loss. You've locked in a $2.30 loss. I mean, you have to have that underlying expire worthless, or have to have these puts expire worthless in order to just write out that put. The bottom line is if you're bearish, you just want to pay off. You want to make this, you want to buy this for value, all right? So you don't have to worry. Volatility expands in this back month. That'll help you because you bought it. But pay less than 75% the width of the strikes, and then you're good to go. But one thing to note with this, right now with these really wide markets, $18.88, I doubt I would be able to buy this strategy for $18.88. It's putting me up, $3 above where it's trading, or $2.50. I'm probably going to have to go closer to where, I price this in. I subtract my debit from my long put. That is basically saying you're buying this underlying at value. You're getting these puts for value. So, I would know that I would need to change this to, I would start out at like $19, with the way the markets are moving right now. Somebody could come in there and hit that offer and you get legged into this spread a lot better. So yeah, obviously I would start out at a much better pricing, but just know that you're going to probably get closer to that $21, which, if you're long put minus the debit equals to where this is or higher, then you're good to go. You don't want to be doing this lower, in the case of where you're paying more than the width of the spread, your break even is going to be much lower than where it is right now. So we want to make sure that if this underlying goes down and hits these 45 puts in the next couple of days, then we're probably going to get to my profit potential, okay? My profit potential is 50% of the max profit, right? And, in this case, my max profit on this one, let's just change it to 21 or $20. let's just say it's $20, right? Or actually 21, just to make it right. So my max loss is 21 because that's what our debit paid is. Our max profit on this is the width of the spread, $30 minus that $21. So my max profit is $9. I would get out of this at about, $4.50 increase. So when this debit, I can buy it back for $25.50. That's what I'm going to do. And if it happens in the next couple of days where it comes down and trades 45, I'm probably most likely going to be very close to that. All right, so you won't have to worry about that so much. ConocoPhillips is the one that I pulled up as a snippet tool because, like I said, the markets got really wide. So I took a snapshot of this before the market closed. As you can see here, I'm buying the, it didn't pick up the strikes because I scrolled away from it. But anyway, you can see the markets were much tighter, despite the fact that they still don't fit that rule of being less than $100. You can see here, though, again, 35. If I pull up this 35 right here, the 35 puts minus that $5.09 puts me about $29.95. So I'm still being able to get those 35 puts higher. I paid off all the extrinsic value. My break even is above where we currently are. So that is a good one. And if you take the, if we take that calculator out again and say that we got that $5.09, so $5.09 divided by the width of the spread, which is, it seems like you're paying a lot for this, but $5 minus that $7, actually $8 wide, divided by the $8 wide, you can see that we're getting that for less than that 75% the width of the strikes. A lot of times and you can see the difference again here with the volatility that we've got. My pen now, oh, it's on a highlighter. Let's do the red pen. You can see again here, 121 versus 105, right? This is higher. So we're selling puts in a high vol and being able to buy them in very low vol. So we're getting paid to sell those puts there. All right. When do we get out? So we get out at 50% of max profit. So again, on this one, my max profit right here on this one is $3. Let's call it $3, $2.91, right? So my max on this, max profit is $2.91. Right? That's a max profit. That's a max I can make on this. But my rule is take 50% of max profit. All right. So if I'm taking 50% of that, we're talking that equals about, let's just call it $1.50. My brain's a little mush from doing math all day, and I'm just going to call it $1.50. So my exit is when my strategy increases by $1.50, which would mean I would be buying this back when this value, I paid a debit for it. I'd actually be selling it out. I'd be selling it out for a credit, sell it for a credit of $6.59. So that's where I would get out. Does that make sense? So 50% of max profit is what I'm looking for. And if this market comes down, if ConocoPhillips comes down and hits that 27 strike, I'm going to be very close to that. If this ConocoPhillips traded down there and hit that 27 tomorrow and it increased by $1, I only got $1. You guys, that's one of my rules also is if it comes down there and hits my strike, I'm just going to get out of this strategy. I don't want to deal with, the whole stock getting put to me and now I'm long that stock and now I've got to go out there and I've got to assign the stock to somebody else and blah, 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 blah. I don't want to deal with all that. So in order to avoid that, I'd much rather just get out of the dollar than deal with the headache of all the assignment risk and all of that stuff. But just know that it doesn't matter if tomorrow ConocoPhillips opens up at 20, right? Now you're like, oh my God, I'm long at $27, blah, blah, blah. Oh, what the world's coming to. Well, keep in mind, you've got that 35 strike that you're going to be short the stock at 35. So you're short at $35 and you're long at $20, right? You still, or at, you're long at, where would they put you at 27? You're long at 27. So you're still making up the width, which would be $8, right? And then you minus the debit paid, which is $5.09. In that case, if you did all the assignment stuff, then you're going to be able to get that full max profit on it. But you're going to have to take out all those commissions from the assignments and everything else. In Facebook example, the long put price is about 28, which includes extrinsic value to the short put. Let's do you check how low it was in 2008? You know what? I'm not looking at that right now, Banu. I'm just kind of looking at the probabilities on this strategy. If it goes down there and hits it, then those are great problems to have, right? Despite the fact that you might not get the max profit totally, well, you've made up the difference. You were directionally right, and you're going to make up all of that money from the move on the deltas and everything else. So those are good problems to have as far as I'm concerned. I'm looking to just get out of the trade. I'm in this for a trade, really, in these markets. The Facebook example, let's go over this again. What were you looking at on this? Facebook example, the long put price is $28. Yes, right around $28, which includes extrinsic value. Yes. Well, so I sold this. What I did is I went in there and I look at it like this. Okay, that 35 delta, maybe you want a little bit less risk. If I were to sell these, let's just look at, I don't know if it's going to work out, but sell the 135 puts, right? That's the 25 delta. That's a little bit further away. Maybe you're a little bit more comfortable, but that's going to mean we're going to have to go further in the money. It's going to be a little bit more expensive too. But so my rule here is we're looking at this mid-market. So $6 and can we call it 35 cents is basically where I'm thinking I'm going to be getting these puts. So $6.35. I'm going to have to look at these and say, that's probably close to mid-market, $6.35. Can we agree on that? So I'm looking at the corresponding calls because the calls have all extrinsic value, and that's a floor trader hack. So the in-the-money puts, you look at the corresponding calls, and usually that's a pretty good ballpark as to what extrinsic value of these in-the-money puts is equal to. All right. So $25, subtract that $25 from 180, and that's going to put us at 145. So too much. We're not paying off all the extrinsic value in that. That seems a little wanky. 155, sorry, my math was off. 155. So we're still getting it slightly above. My math was off. So 25 minus 80 is 155. So we're still getting that above. I probably have to pay a little bit more for this, maybe 27 or something. But you're going to have to go back and see if these strikes still work out. I'm guessing they are just because volatility is still high in those front months. So now we have, this is $45 wide, right? And we're paying $25. Let's just say we had to pay up to $26 to make this a little bit more realistic. So $26 divided by that $45 wide. That fits that rule then. Okay. I probably maybe even have to pay up to 27. Something like that. If it was 27 minus that, then we're very close to where this underlying is now trading. So you know that that's as far as you're going to go, right? Not going to go much further than that. So if it was 27, if I had to pay to 27 on a $45 wide, that puts it still at 60. So that's good. All right. But know that we're not going to do any more than that, right? Because 180, we don't want to have the 180 minus our debit paid, $27, 153. We don't want to pay much more than this. But we probably don't want to pay any more than that. We probably want to pay less than that. We want it to get it to where it's equal. 153, we're basically not paying off all the extrinsic value, right? Because now my break even is below where the current underlying is trading. So I want my break even to be above where the current underlying is trading. Are you saying that it is preferable to have the break even higher or equal to than the current price? Yes. When you do this, subtract your debit from the long put. I want that number to be higher than where we are currently trading. Yes. Or equal to it. If it's equal to it, then you're getting those for exactly value. It means you paid off all the extrinsic value. If you can get it for higher, which we're able to do a lot of times right now, because volatility is higher in these front months than it is in the back months. Okay? So we're good on that. So it means when we're selling these, we're getting paid for selling these, and we're buying cheaper volatility out here. All right? So yeah, you want to be able to subtract this debit from the long put, and hopefully it comes out a little bit higher than where we are there. All right? So, $27 or something. $27 and some odd cents or something. Okay. Sometimes it might be, if it's trading 153.21 and basically you're pricing it in and it's trading, you come up with 153.10 or something, that's not terrible. Yeah. So let's go to the, you want to see it on the analyze? So this is, we don't want to do the Facebook. Let's do one that's clean. Let's look at that ConocoPhillips. COP. They don't have to see all the stuff I have going on. All right, so the ConocoPhillips trade, let's delete this. We're going to look at the 35 deltas here. So we're going to sell the 26s. Sell the 26s. Going mid-market on this. We're thinking basically, 325 or something like that. So I'm going to look at these right here. So the 33s. We can buy those 33s. So $4.69. Let's pull up the calculator again and say the $33 minus the 469 equals $28.31. So that's we're right in and around where that's at. That is good. We need to look at the $33. Well, I could just do the math, right? So $7 wide. So it's $7 wide, 33 to 26. We got $7 wide. So I'm taking that $4.69 and divide that by the $7 wide. What do we get? 67% the width of the spreads. We're good there. So let's look at the analyze on it and see the profit and loss on this. Analyze tab. Go to the analyze trade. You'll see that I got the old one up there. All right, so you can see that the analyze tab is going to show that if this market continues going down, it's going to continue going out. It's going to start leveling off a little bit. There. See that levels up. Oops, I'm going to try and pull this up now. So you can see that it's going to level off once we get to that plus the debit there. And then to the downside, you know, it's going to, once we've reached that strike, you know, the width of the strikes, it's gonna flatten out some. It's going to continue going because it's a product of your deltas that are in the money. All right. These are going to eventually start being worth, like in theory, 100. And these are going to be, you know, like an 85 delta. So it's going to show it kind of reach out a little bit. Funny like that. Okay. You good there? So obviously, this is another reason why I say, you know, cover it as soon as it hits that 26. Comes down there and hits it. You could lose a little bit of money on that trade if it starts going. So just cover it as soon as it goes down there and hits it. Might not be exactly that full, you know, width and everything, but you'll get most of your money back on it, most of it. So there's no problem staying in this trade since you don't lose after a short put. You don't lose because you can always assign, if somebody assigns the stock to you, which means since I'm short a put, right, and all of a sudden it goes down to say 20 or whatever, I'm short this put. Somebody could be like, you know what, you're taking my stock at 26, meaning I'm long now at 26, right? But keep in mind, because I'm long this put at 35 or 33, I can just be like, you know what? You're taking my stock at 33 for the person, whoever sold me my puts at 33, right? I can just assign them. So then I make the width of the spread because I'm long at 26 despite it's trading at 20. And I'm getting short or out of it at 33. Somebody puts the stock to me at 26. I'm long stock at 26. I need to go and say, hey, you know what? You sold me, or I sold you this stock at 33. And you basically assign it to that person, whoever owns this, the other side of this long put, the writer of this long put. I bought it at 33. It gives me the right, but not the obligation, which is why if it goes above 33, there's nothing going to happen. I'm not going to do anything. And if it goes further down, I can always put them that stock, which means I get out of my stock at 33. All right. All right. Well, without further ado, then, without any more questions, that's how we're doing this. And Banu, I hope you are paying for my services because I'm going to teach you guys why you're not making those other mistakes. In other webinars on this long put diagonal, you know, when the volatility swung out, you know, in different directions, I've shown example. I couldn't find an example where, like Banu brought up, where you can pay more than the width of the spread. That is a pitfall of this strategy. And I show you how to avoid those pitfalls. So for something like that, where you're locking in a loss, you know, for $97 a month, you guys are able to avoid those pitfalls. You know, yes, you know, sometimes free information is free, but it's worth just that. It's worth nothing because even the guys on TV that are still touting buying options right now in this type of environment, just outright buying options is just not the right thing to be doing. I don't care if you're directionally right. Therefore, you know, we're offering this service. This is the Options Premium Education Package, where you basically get access to everything that I have done and or am doing going forward. So let me pull up this right here. I'm going to copy and paste this into the window so you guys can take advantage of the hot link. There is all kinds of webinars and everything else. You also get access to me, you guys. You guys have questions. I know that there's a lot of questions being thrown around out there right now with your portfolio. is going on with your portfolio and how you should manage it. I can tell you what I would be doing with my portfolio given the circumstances. I can't tell you exactly what I would be doing, or what I can't tell you what you should be doing. All right, I can just give you the facts and a little bit of my history and everything. So all the trading workshops, live trading webinars, free access to all of that, the premium membership trading courses, all of that for $97 a month. These are all of the different webinars. Some of them are like the long put diagonal. This long put diagonal is going to maybe even have some of those examples where we talked about you can lock in a loss. So all of them are different because they're different scenarios. We're looking at different things. I'm looking at implementing options into into our portfolio as a hedge. All right. So if you're doing something like this around SPY, you know, and you have say a $100,000 portfolio, you know, you might be doing this with 1 or 2 SPYs. Okay. So that would be hedging that portfolio. Given those circumstances going forward, kind of like I talked about in the last one. So for $97 a month, you guys, it will avoid those pitfalls of doing something crazy like somebody telling you to lock in a loss on a strategy. So all of these are set up, and yeah, I have some free content out there on Facebook and on YouTube, but these are built as courses to start out and ramp you guys up into becoming stronger traders. Start out very simple with the basic concepts. You know, like I don't go over what delta, gamma, and all of those things are doing, the strategies, or how you figure all that out in this one, because we're further along, right? And I'm assuming you guys got that, but you guys should take advantage of this. The link is over there in the chat window. If you aren't on the chat window, you can, and are watching this on tape delay, you can just punch this up here into your URL. But again, you get all of these different ones. Again, the URL down at the bottom there that you can take advantage of it. All right. That's all I got for you guys. I hope you guys at least learned something. If you guys like the way that I teach, it's a little bit different than most people out there. I can help you out with that link over there in the window. And again, you have free access to me, unlimited. You can call me, email me, whatever. If I can't email you back with the answer, I will get your phone number and we will walk through it ourselves. And another thing with this, when you get it on the website, is if you watch the long put and you were kind of thinking, okay, I'm pretty bearish, you could check them off for different saying, I watched this one, and then, you know, check them off as you go along there. Go over, I've watched the long call spread here. Maybe I'll look at the long put diagonal over here. So it'll check it off to show that you've watched those. All right. So you don't have to watch the exact same one again. Because like I said, everything's a little bit different. You guys drive the content as we go along. So sometimes we get different scenarios and different things. Eric, have you considered how to grow a small account webinar? I do have some of these in there where we're talking about small accounts, exactly that, you know, like how do you go out, and if I can't afford to buy 100 of XYZ because it's too pricey, how do you buy 50 shares of something? So yeah, we could definitely make it a little bit more catered to that for sure. I don't want to exclude anybody necessarily, so I try and talk about both of those as we go along. But yeah, check these out, KM, because especially like on the risk reversals and the synthetic long stocks, you know, I talk about how that is a lot cheaper than going out there and buying the underlying outright. So you can buy some of those higher priced stocks. So take advantage of it. Click on that link, you guys. That's all I got. Other than if you can't take that, take it easy. Have a good one, you guys.